Hey, what's up guys, it's Jonathan here. Wow, we just got two really big job reports that I think that the Fed will be looking very closely to. Both the JOLTS reports from the BLS and then the ADP private payroll report as well. So in this video, let's go through both these reports and see what we can pull away from these reports to determine what we think the Fed will do in terms of getting inflation down. So let's get right into it. So with the JOLTS report that we just got on Wednesday, it showed that there was about 10.5 million job openings, which was flat from what we saw in October, but the expectation was about 10 million. So we did definitely come in well over the expected number. And obviously that led markets down as that created fear that the Fed will be more hawkish at their February 1 meeting. So some of the sectors that played a really big role in this upside miss that we got on the JOLTS report was professional and businesses services, which added 212,000 jobs in the month of November. Non-durable goods manufacturing, which added about 40,000 jobs into the market. And this is a big reversal from the October report that showed a 95,000 job decline in that sector. Then we also had a pretty big decline in finance and insurance industry with a subtraction of 75,000 jobs, which is another big reversal from the October report that showed us that this sector actually grew 70,000 jobs in October. And then we also had federal government jobs, which declined about 44,000 positions. So when it comes to hires, the only significant increase we had was in the healthcare and social assistance sector, which increased about 74,000 hires. And this is not surprising given the shortage in that field even before the pandemic happened. We also had the high demand of them during the pandemic, and then even now there's still a shortage. So this isn't really too big of a surprise. Now, when it comes to separations, let's first start with quits. And pretty much what quits are just people who voluntarily decide to leave their job. And this is really important to watch out for because it shows that employees in certain sectors still have a lot of pricing power and they have the ability to leave one job, go to another job and get paid more. So this is something that we really have to watch out for. So there was about 4.2 million quits in the month of November, which is up from October's number of 4 million flat. So about a 5% increase. The quit rates for very small firms, which are firms that have less than 10 employees, increased over the month of November as well. And I'm not really too sure why this might be. It could be either because these employees wanted to move to a bigger firm for more job security, given that there is a very big belief that we may end up going into a recession, or they just want to work for a larger company that could pay them more money. Not really too sure, but it may be one of those two situations. And the sectors where we saw the most amount of quits was in healthcare. So this shows that a lot of healthcare professionals still have some pricing power to maybe switch jobs and get better pay. We saw quite a bit of it in transportation, warehouse, and utilities. And we also saw a good amount of quits in the information sector as well. Now, one thing that's important about all three of those sectors I just mentioned is that they're all fields that have elevated salaries for most of their employees. Typically, people with elevated salaries, when they make more money, they tend to spend it in a manner that's more discretionary. And more discretionary spending ends up leading to more upwards pressure on inflation because the velocity of money for discretionary spending is much higher than the velocity of money when it comes to non-discretionary spending. And pretty much what velocity of money is just the amount of times that a dollar will move in the economy. So pretty much if I spend $1 on an iPhone, that dollar will multiply 7x on the GDP when we calculate GDP. So that's something to keep in mind there. But this upwards pressure on inflation may actually be offset by the easing in supply chain issues that we saw earlier on during the reopening start to ease at this point. So when it comes to layoffs and discharges, it was pretty much flat month over month. We did see an increase of about 20,000 jobs in the finance and insurance sector. When it comes to other separations, pretty much this is either separations due to death, disability, inter-organizational transfers, or retirement. We saw a 49,000 job increase in separations in the professional and business service sector. And in my opinion, I think that this is probably driven by just end of the year retirements. A lot of people like to retire in November and December so they could go be with family for the holiday season. So that was the jobs report we got on Wednesday. And then just this morning on Thursday, we actually got the ADP report. And the ADP report covers December data, whereas the JOLTS report covers November data. So this is a little bit more updated. It does focus a little bit more on private payrolls and doesn't really focus so much on the public sector. But given that about 85% of the jobs in America are private sector jobs, this is still a really good indicator about what's going on in the job market. Some contrast from what we saw in the JOLTS report is that the ADP report states that hiring is still strong with small and medium firms, but large firms are actually cutting jobs, which was very different from what we heard in the JOLTS report, where we saw that quits are actually going up in small firms. So some of the numerical results we got is that the private sector increased 235,000 jobs, which was a significant bump up from what we saw in November data, which showed a 127,000 job increase. And when it comes to annual pay, it's currently up 7.3% year over year. Whereas on the November report, it was up 7.6% year over year. So it's good to see that we are starting to see annual pay increases start to trend down, as that will put less possibility to a wage price spiral and hopefully is less pressure on inflation. This is starting to get into a range that's very concerning, just because CPI right now is currently at 7.1% year over year. So given that we're seeing pay like in the same neighborhood, it could signal that we may be at the point where we could get a wage price spiral. But it is trending down, which is good, but we have to hope that we continue to see this trend start to move down even more and start to follow inflation as well. Because if the Fed does sniff out a possible wage price spiral, that's definitely put a lot of pressure on them to continue their aggressive rate hikes. So when it comes to the goods producing sector, it increased its workforce by about 22,000 jobs. In November, we actually did see a decrease in this sector, so it's very interesting that we're now seeing a significant increase in this sector. And the increase was driven mostly by the construction industry, which added 42,000 jobs after losing 2,000 jobs in November. So moving on to the service producing sectors, there was a gain of about 213,000 new jobs. And this was led by leisure and hospitality with 123,000 of those new jobs. And this is significantly less than what we saw in November at a job growth number of 224,000 jobs that we saw. It still made up a significant chunk of the service increase that we saw. When it comes to trade, transportation, and utilities, that sector actually lost about 24,000 jobs in December. And this is a significant reversal from what we saw in the November JOLTS report and the ADP numbers from November as well, where we saw increases in this sector. And when it comes to professional/business services, we saw an increase of about 52,000 jobs, which is in line with the November JOLTS report, where we did see an increase as well. But it is a pretty big reversal from what we saw from November ADP numbers that showed a decrease of 77,000 positions. So breaking down job gains by region, one of the significant things I saw is that on the West Coast, there was actually a significant downtrend in jobs in private sector jobs on the West Coast. We saw a decrease of about 142,000 positions in the month of December. I think this is mostly due to the increased cost of living on the West Coast. I was talking to some hiring managers just recently, and they're talking about how hard it is to hire on the California coast due to the cost of living and how expensive it is to live there. So this is something that I think will be a longer run trend that we should probably pay attention to. Another significant increase in jobs I actually saw when it came to region was we saw a significant increase in the southern part of the country with an increase of over 250,000 jobs. So it seems like there's a big migration away from the western part of the country and maybe possibly to the southern part of the country. When we look at the job changes by the establishment size, we see that both small firms and medium firms increased about almost 200,000 jobs per each. And in small firms, we saw the amount of quits increase on the JOLTS report. So it was interesting to see the JOLTS report say that quits increased, but then the overall number increased on the ADP report. But then again, granted, they are for different months. So keep that in mind. On the JOLTS report, we also saw separations increase with medium-sized firms, but it seems like in December that number rebounded according to the ADP report. So again, some more discrepancy between the two reports. And then on the larger firms, we saw an actual decrease of about 150,000 positions. So when it comes to annual pay increases, people who stayed on their job had an annual increase of about 7.3% year over year. Is good because it's trending down from last month's 7.6%. But it's a little worrisome because it's at the levels that are very comparable to CPI year over year. If we do see this number reverse back up, it may cause some concerns that we may be heading to a wage price spiral. So that's something to keep in mind. When it comes to job changers, their annual pay increase raised to 15.2% from last month where it was at 15.1%. Now, this isn't a good sign for inflation coming down, especially that we are seeing more jobs become available. So it gives people more of the opportunity to change jobs and take advantage of this, of a possible wage increase. When we break it down by sector, we see the biggest increases in leisure and hospitality at 10.1%. And we saw the smallest increase at 6.9% in professional and business services. The professional and business services make sense because they tend to have much higher salaries than people who work in leisure and hospitality. So dollar amount, it may actually end up being the same, if not lower, than the leisure and hospitality gains. But that is something to keep in mind as well. And this is pretty consistent with the overall post-pandemic wage gains that we have seen. And then the smallest increases were more in the professional and business services sector at 6.9%. And that's a little understandable because usually the people in that sector are more like lawyers, engineers, doctors. Like they're people who have higher incomes anyways. So it does make sense that you'll see a smaller percentage increase. This has kind of been how it's been throughout the entire like post-pandemic economy. So there's really no shocker here. Now, when you break up the annual pay increases by firm size, we are starting to see the smallest increases at the smaller firms and the bigger increases at the larger firms, which may actually prove what I was talking about earlier with the JOLTS report, that that's probably what we're seeing. We're seeing people quit jobs at smaller firms and move to larger firms where they could get paid more money. Both these reports are showing that both growth in not only job numbers, but also wage growth is starting to slow down. Not as sharply as the market expects or the market wants, but it is starting to come down, which is good news. But by seeing quits increase month over month, it is a worrying sign that wage growth might continue to keep pressure on inflation. But it should be noted that a lot of these quits are in fields that are already short-staffed and have been short-staffed historically. So it's not really too surprising that we are seeing a lot of quits in those fields. The reduction of private sector jobs on the West Coast was an interesting thing to look at. It shows how unaffordable the cost of living has become on the western part of the country. I feel like this may end up continuing to be a long-term trend as we move forward, just mostly because there's so many different things that do drive the cost of living, and this has been the trend that has been going in this direction for quite a while. So that is something kind of to look out for. With all of this data, what we really have to remember is that jobs data is always a lagging indicator to what's actually going on in the economy. Usually we don't see unemployment start to increase until we're well into a recession. And a lot of times the Fed's actions do have a lagging effect on the job market. And they did acknowledge this in their meeting minutes from their last FOMC meeting that was released on Wednesday. So in my opinion, I think that what the Fed is really looking for is a consistent trend downwards in inflationary pressures and not necessarily looking for a specific number. Even though they are talking about, oh, we need to get back to 2% inflation. I think really what they're focusing on is just getting inflation to start coming down. And once we have consistent data that inflation starts to come down, then I think they'll start to maybe not cut rates and relax, but they'll just keep rates high and they'll let the tightening kind of work into the economy and then start cutting rates once there's clear sign that we have most of inflation behind us. So I'd like to thank you guys so much for watching. If you enjoyed, please hit the like button and subscribe, and I'll see you in the next video. Peace.